All right, ladies and gentlemen, welcome back to the fastest growing life insurance podcast on YouTube. My name is Caleb Guilliams. We got Dominic Rufran. And today's episode, we're going to talk, or quite frankly, react to my debate with Jim Dew. I had the opportunity to debate Jim Dew about whole life insurance and infinite banking. And in this video, we're going to talk about how it actually went. The cool thing was we did an episode where I prepped with you guys, and the part one is already out, and most likely at the time of this recording, part two is going to be out. We're only going to react to part one, but it's been fun to get feedback. We went through the comments. Dom, you have not watched it to date, so it'll be interesting to hear your perspective. But I think first and foremost, really grateful for the sit down conversation. Bob and Ben Frazier did a great job, and they had Jim Dew on. I have a ton of respect for Jim, and so it was great to be on, and we had a good conversation. I will say that they edited it, so not only did they chop it up into part one and part two, but they did change some things. I had like a 7-minute monologue, which, they were all making fun of me on that, but I do think it was important to set the stage. And so the monologue was intentional. They switched that around and cut some things out. I get it, because they didn't want to start the whole episode off with a super long monologue, but I think it is important to know that what you saw was not chronological standpoint. And then thanks to our producer Joel, he shared some talking points throughout the conversation. But the big thing that I'll say is Jim was not as anti-life insurance as I was expecting. So first and foremost, he was open to the conversation. He was way more open and liked IUL than I was expecting. He had a lot of interesting talking points, and whereas you could almost dunk on IUL, he was almost justifying, or just he pitched. Now, I wouldn't say he pitched, but he was, I would say, just as much of a fan, if not more of a fan of IUL than whole life, which is an interesting in itself. And then all the talking points that I knew he was going to bring up, that it's way oversold, misunderstood. He talked about there being better disclosures. He talked about fiduciary. All the things that we knew he was going to talk about were brought up. What I wanted to do is I sent him an illustration, a couple illustrations that I would like to go through. He didn't have enough time to go through it, but I was like, if we do a part two, I would love your take on these illustrations, because it's easy to throw out generalities and say this whole life is a black box. It's not flexible. It's easy to throw those things out. It's like, okay, let's walk through it, because I don't disagree with what you're saying generally, but we're doing something different. One of my regrets, though, this is the thing I wish I would have done better, because time and time again, Jim would say this. I would say a version of this is you would almost be like, hey, even if you're sophisticated, you don't know what's going on. You're going to get the industry is tough. You could be really negative, the industry and how things have done in the past. And I said something briefly about the credit card example. It was just because a lot of people have credit card debt doesn't mean you shouldn't use a credit card. And so that is an example. I wish I would have gone back to that, because I think it's a good example. It's yes, you're right, but we're having a podcast, and the people listening, the people that work with Ben and Bob, are very sophisticated people. They're investing in investments that the average person doesn't have access to. And so it's a little bit hypocritical for us to say use that over and over again. And it's an example of, maybe someone like a Dave Ramsey saying just because people are in credit card debt means you shouldn't use a credit card. Another example I wish I would have said, because I think it would have resonated with the audience, is if you look at the failure rate of businesses, business fail rate is massive. The amount of businesses that fail in the first year, second year, 5 years, insane. So does that mean, Dom, that we shouldn't start a business? Does that mean someone shouldn't start a business because the likelihood of failing is high? It's an important note. Maybe you shouldn't quit your job to start your business right away with that. But that, myself, Jim, everyone on that call have resulted lots of benefits from going through and being the minority. So I think that would be like the biggest like theme. And obviously we can go through some of these talking points, but it's like, no, there was no curveballs, and in fact, I think it was a good conversation. And there's good feedback, but I do think it just continued to go back to like the industry, and it's like, okay, what I wish I would have done is reset and say, and with all due respect, I agreed, but we're talking to the person let's make the assumption that this person's gonna talk to the right person, whether it's with us or somebody else. And so there's still cons, even if you set up life insurance properly. There's still cons. Let's talk about that. And let's not just use the same talking points that it's so easy to get into. And so as I reflect, that's probably the one thing that I wish I would have done a way better job. And then there's hindsight's 2020. There's a lot of things that you're like, man, I should have said that or whatnot. But that's always going to be the case. And so that's my overall feedback before we jump into some of the talking points.
It sounds like nobody should ever go to the doctor either, based off of what you're saying, because one person dies from going to the doctor, then the doctor's officially bad across the board. And
Yeah.
I do think that is the most, for me personally, the most frustrating part about just the industry as a whole is that the industry is there specifically for a reason to help, a reason to serve. Obviously, there's the capitalistic part around it, but there are really good products when used properly, appropriately for the right person. And unfortunately, because of the bad eggs, everything gets generalized and lumped into one assumption. And it creates a really hard narrative to help people see like, hey, this tool can be very helpful. And then the people that have a very bias to other specific products, it's their natural, like, oh, here's my defense mechanism to like why your thing goes so bad, and why I do this is because the industry is just like, rated on a scale of 1 to 100. It's literally like a 10 on a trust scale because people think of whole life insurance agents as scammy, as in close to car salesmen, right? And that's indicative of how it has been sold by a lot of people, so rightfully so. But it's unfortunate that that's where we're at because it's not all like that.
Yeah, I think if we did do a part two, and I would love to do a part two with Jim, maybe even on this channel or on the Better Wealth channel, it would be having a dialogue around efficiency and saying, all right, Jim, we get the talking points around insurance in general. Let's zoom in on this type of policy design. This is where one could use it. Let's talk about the pros and cons of that scenario around the idea of efficiency. And that's where we could say, okay, he might have some disagreements and we could get into the math. But then it would allow me to say, okay, instead of let's just talking about the negatives of insurance, let's talk about the positives. Let's talk about a permanent death benefit. Let's talk about the living benefits tied to life insurance. Is there some scenarios where this policy actually performs way better than yours? The answer is yes. There will always be scenarios that you could paint in both worlds where one scenario is better than the other. One thing that I think could happen is if you look at lots of different scenarios, I believe that just like a volatility buffer gives you better options in retirement, having a life insurance policy gives you just more optionality. And I do believe that is something that Jim could speak to. I think he would agree with that. And then I think he would also have some points to push back on, which would be valid. But that would be great. If we did part two, it'd be fun to like talk about policies that we do under a big assumption that, make sure that you're setting these things up this way, or he could push back on the way that we're setting things up. But, he would say things like IUL is way more flexible than whole life. Generally speaking, he's not wrong, but the way that we structure whole life is super flexible, and you're eliminating a lot of the downside risk of an IUL chassis. So it's like, that's where it's tough, because it's like, okay, do I want to push back on every little thing that he says? No, because I don't want this to be like super argumentative. I don't want to like major in the minors. But anytime you don't correct that, then it seems like you're complicit. So that's what's tricky about this whole thing.
Yeah, it just comes back to, again, education of like fully knowing the full story. That's why it's so hard, I feel like, to debate anybody or have a really good sophisticated conversation when both people don't actually fully understand both sides, because you speak in generalizations, you say things that actually aren't true, you undermine the reality of how things actually are. And so I do appreciate just you in general. Usually when you go into some type of debate, really looking at the scope of the other person's side of it. Something to consider if you do go into part two is I saw the illustrations that you sent him. Obviously well designed, great illustrations, but illustrations by handing over without context or knowing how to read them are very difficult to understand. Where do I look? Where do I go? There's 100 pages. There's 7 different columns. Like, what do I look at? So it'd be overwhelming for anybody. And so I do think that going live and saying, here's the illustrations, let me walk them through you. Here's the cash value. Here's the death benefit. And then ask questions accordingly would be an incredible episode. Like, I think a ton of people would love to watch that in real time of like, hey, here's the policy. Here's the illustrations. Like, now I'm just curious to hear what you think now if you still feel the same way. So yeah, they should definitely do a part two with something like that. That'd be fun.
Yeah. And I don't disagree with what you're saying. And he was pretty adamant on having time to vet it because he's not wrong. Insurance illustrations can straight up be super misleading. And that's another thing. I agree. I actually very much agree. And then I'm like, this is only going to bolster our situation because everything that we do is set up for all of these talking points. So let me go through some of the talking points that Jim did in timestamps. And obviously we'll have the link to our full episode down below. If you've not checked it out, please do. Please give them some love. We'd love to hear comments, feedback. I've read all the feedback and comments and it's only made me better. And I really appreciated that. So obviously, Jim has his opening statement. Ironically, they took out my 7-minute monologue. They changed it up a little bit. And then he spoke for, a good chunk of time. He spoke for 2-3 minutes on just like his story. And then he talks about the whole life being expensive. He talked about that in minute 14 is like whole life is too expensive. It's like, well, you and I both know like how we can go about that. It's like, okay, are we talking about general base whole life compared to a death benefit? Sure. Let's talk about that. Even though you could make the argument long term, it could be less expensive than term because term most likely will never pay out. So while the whole buy term invest the difference concept is key, term insurance, if we actually want to be super technical, is the most expensive type of life insurance if it doesn't pay out. That's, and actually Bob got that around like he's like the renting versus owning. He's like, I want to own. So there was like some attraction level around that. He talked, Jim talked about dividends dropping and how when he first got started, life insurance was so much better than it is now, and how life insurance has underperformed the illustrations. If you look at in the 80s, it's valid. But then again, you could say that about everything. CDs, is your CDs or the bank account a scam because back in the day they paid 9%, now they pay 2%. It's like it's just the nature of the environment, and that's where I think one of the biggest differences is I don't look at life insurance as a stagnant lock up my money for the next 40 years. I look at it as like a fluid place to flow money, protect my family, and use. And so, I mean, that's just a philosophical difference. And yeah, I would agree. If I was looking at an illustration in whole life and expecting a 9% IRR, and it's going to underperform that. And if I just looked at it from an investment standpoint, that's something to factor in. But I also think the flip side of that, today is like the greatest time to show an illustration, especially in whole life, because the illustrations are a lot more conservative. Like what Jim mentioned is super valid and like is impossible to have that big of a drop because we're so much closer to guarantees, which I like because I think life insurance, if the guaranteed column, you should be like the guaranteed column, you should be able to still sell it, even if you're looking at the guaranteed column and factoring in the fact that there's going to be things in addition to the guaranteed column, but life insurance at its purest form should still make sense even if you looked at the guaranteed column. And that's a thing that I wish I would have done a better job, like going back to and sharing. But it was just one of those, like, you have to pick your battles and you're like, okay, that's not something that that's not a hill that I'm willing to die on right now. No pun intended, but that is something that was mentioned. Anything you want to say? I want to talk about his take on infinite banking.
No, I just hear like I shared, I didn't watch it, but the things that I'm hearing, it's the same story, different song, like across the board. It's kind of the whole Dave Ramsey persona, and to some degree, it's like you say something with a statement that's blanket, but that's not actually correct. And so I'm like, okay, same thing, different. Okay, that's not how it works. We understand, so on and so forth. So across the board, if there is a part two, regardless, I really hope that either A, he's able to come prepared with some of the other sides of like understanding, or B, in the part two, that's where he can really get educated on how the asset really can perform, right? And it is interesting that he is a big IUL fan relative to
I
whole
wouldn't call
life.
him big. I would say if
Or
he's doing a permanent life insurance,
insurance.
I would bet you that they do more IUL than whole life.
Okay, it's just because of the statements that he's trying to say aren't good for whole life purposes, specifically like the dividends dropping or policy performance like not being what it is in the past. Like IUL is probably the biggest proponent of having an illustration, even in today's time, of showing like different performances across the board. So it's just super fascinating, or just in general, just hearing someone as sophisticated as him say the things that he's saying. And so I'm actually going to really go ahead and watch this. So if you guys haven't watched it, you definitely want to go and watch it, because it sounds like it was a really good interview or slash debate.
Yeah, and just there will be a part two on their channel. And again, make sure to support them. But I would love to have him as like we'll call it part three, because they split up the interview in two chunks. So yeah, appreciate that. We then talked about infinite banking, and that's where I think some big differences came out, because he, wasn't, I would say, the biggest fan of the concept of infinite banking. And I mentioned straight up that you don't get cash on cash arbitrage. I think that would have been a big pushback he would have gave if I went down the road of like, your dollars grow, and you're like, I think that would have been really, really easy to get called out on. And so I don't think I gave him any pitches for him to knock home runs out, because again, I think I'm pretty reasonable when it comes to this, because we do talk a lot about this. But he mentioned like, yeah, you could easily get a security backed line of credit from your investments, and you should just do that kind of deal. And that's where I think the comment section kind of like called him out a little bit, because yeah, you're right, you can, but it's not apples to apples. Like, you could also, Jim, take a policy loan from your policy, invest in investments, and then do a security line back of credit from there. So it's like, if you really want to do that, yeah, you could. What's keeping you from doing both? And I wish I would have said that, because I would have been like, wow, that would have been a zinger. Just do both. But I think the other aspect is assuming that the assets are the same. One can go down in value. One's more risk than the other. And the other aspect is, are most people giving 95% access to security backed lines of credit? Usually it's about 60. So that even if you play that out, there's pros and cons to that. And that's where I think when people heard that, it's like, okay, you're not necessarily comparing apples to apples.
And the most important piece, which is what makes it all go. Without it, you could argue potentially, but the death benefit.
If you're an advisor, life insurance agent, or someone who just loves the life insurance space, we have a must-attend event for you. It's our 5th annual Life Insurance Summit, June 15th through the 17th, right here in Nashville, Tennessee. Not only are we going to have the biggest names in the life insurance space, but this is also an incredible opportunity for you to meet and connect with like-minded individuals and be a part of our ever-growing community. Learn more and get your tickets before they sell out in the link in the description or pinned comment. Can't wait to see you there. You're right. You're totally right. And all the other benefits. That's why we continue to go back to the more benefits you understand about life insurance, the more the asset itself should be elevated. And that, again, I said that, but if someone's not really like, it's you sometimes have to hear it 10 times or 20 times, and sometimes you have to experience it. And so that would be something that we could probably do a better job with. And then the other aspect is, if you're going to say that life insurance is bad because of rate of return, okay. But then the fact that you can lend against it and put it into something that has a great rate of return takes that out of the equation. So then the next question is, it still goes back to efficiency. Would you be better off using a life insurance policy or something else? And while I did mention that, it's hard just verbalizing things. Like, that's where showing numbers. It's like, okay, scenario 1, someone puts their money in a checking or savings account and deploys their money over here. here's the pros and cons. Scenario number two, you're using a life insurance policy. Here's the cons. You don't have all the money immediately. Okay, that's factored in, but there's other pros. And then over time, you stack all the other benefits that you get because your money's in life insurance, and you have the ability to use majority of that capital, in some cases more of that capital, depending on what year you use that capital. And so you get best of both worlds. And that's something that was mentioned, but again, is really hard when you're in a dialogue. It wasn't just Jim and I; it was two other people as well that were there, and love Ben and Bob. But it's like when you're not running the conversation, you're almost at the mercy of what is going to be asked. And so I thought Jim did a great job. While there's lots of areas for improvement, I do think I represented our side well. I didn't feel embarrassed from my performance, but again, there's a lot of areas to grow in, and that's kind of my take. He ended with talking about IULs and then the problem with policy illustrations, which again are all valid. He did mention that, like, to do life insurance well, you should do pre-underwriting before you go through an application. I agree. I think there's a lot of benefits of looking at different companies, potentially getting a quote without having someone's name. That's something that we've done in the past. We're big fans of doing pre-underwriting before we engage with companies. So I agree with all of that, and I do think that hopefully people benefited greatly by hearing different perspectives.
What was his reasoning why you should do that? The last part
just
with the
because
underwriting.
just life insurance varies so much depending on what rating you get. And so if you're just in bed with one or two companies and you're like, hey, Penn Mutual is going to be the best company for you, and Penn Mutual gives you a standard rating, and then Guardian gives you a super preferred rating, that needs to be factored in. So I think it's important when it comes to ratings, especially if a client doesn't get a super preferred rating at a carrier. It's important to see, like, would other carriers treat this person different? And then in some cases, if we're worried about a decline, you would want to see if you could even get life insurance without a decline, so that you don't have to disclose that and say, like, has someone been declined with life insurance? You can say no, because the answer is no. So there's that aspect. And I also think that's one thing that can be said. He also said that, commissions should be negotiable and disclosed. Don't necessarily disagree with that at all, but I would love to know, are you actually negotiating the commissions? Because if that's the case, we should look into that, because that would give us a competitive advantage. I mean, we reduce commissions dramatically on how we go about that. So you could say that that's negotiable, because we're doing everything we can. But the ways that so again, I'll say this: someone should go, if they want to do a life insurance, they should go with the person that gives them the best outcome, not the person that's making the least. So I think sometimes it's really attractive to say, like, I want to work with someone that doesn't do assets under management. I want to do with someone that doesn't do any commissions, because somehow you have more credibility and trust if you're not getting paid from commissions. Okay, that's a fair statement, but then it's like, can you actually prove it? Because just because someone's getting paid a commission doesn't mean bad always. And in some cases, you could be way better off by paying a one-time commission, or a commission that's front-loaded, than paying a 1% assets under management. And again, I know Jim, they charge anywhere from $1,000 to $10,000 a month, or maybe plus, when it comes to their consulting, and that's their fee. So everyone's getting paid, and that doesn't make it wrong. It just means you got to factor in everything into that scenario. And there's a world where just because you can play the fiduciary, I don't get paid a commission, doesn't necessarily mean it's the most efficient, better thing for you.
Yeah, I like to consistently play the doctor game, because on that same scale of 1 to 100 of trustworthy, doctor's actually at the very, very top, in like the top 90 percentile. And, you go into a doctor, you're going to pay the surgeon a buttload of money to get the job done well. And you're willing to do that for the result that you care about. if you want to go with the person that gets paid the least, I'll do it for free. Let's
Good.
see which one you
I'll
prefer
do it
at the end of the
hourly.
day.
Hourly. Here we
Yeah.
go. It is
We'll
funny how
see.
normally if you're doing a big surgery, cost and price, I get with insurance. If we strip insurance out of it, it might change a little bit. But most of the time people want to like who's the best? What's the best outcome? Not who's the cheapest.
Yeah, and it's crazy. And a lot of the times, in theory, it's the commissions and payment aren't even coming from the person who's getting the policy. Now, that's not fully true because you can design the base in a specific way to obviously maximize the cash, which when you do that, you minimize the commissions. But in reality, like you're not actually paying out of pocket
You're
directly to the
indirectly
person
paying,
who's,
but you're right. You're not it's
yeah.
not like real estate and stuff where you're literally paying out of your pocket in some cases.
Yeah. So it's just so amazing to me how like in actuality, the insurance industry, when a professional world, you actually get paid some of the least amount relative to some of these like other industries, but it's one that's known for being like the scammiest high commissions. And so it's super interesting when you like actually break down true dollars and what's going on underneath the hood.
A point that Jim made that was really, really good is we do have backward incentives in our space, which again is an example of the industry, not necessarily us. Like this is a commercial for better wealth, but most people are not incentivized to do the right thing long term. And that would change if instead of getting paid a ton up front and like very little ongoing, you spread that out over 20 years. And he's not wrong. And so there's an incentive to sell and then a less incentive to serve people well, which is a big issue in our space. And I do think things would change a lot if you change that aspect. And so there are good points to be made, but it's almost like but then it's like just because that's the point doesn't mean that everyone doesn't serve people well. That's not an excuse for us to not serve you well because we're not getting paid in the third year that much. That's not an excuse for us not to do that well. So I think it's all relative, but if you're speaking as an industry whole, I think Jim and I would agree and say, hey, if you're just rolling the dice and working with an average insurance agent and going to get whatever they get, I'm going to be the biggest buy term and invest a difference fan out there. Like just, and maybe that's another thing I should say. So it's like when it comes to the industry, we are aligned, but going back to the business credit card example, it's like, okay, but if someone's actually watching this, if someone actually wants to learn about this and work with a really good team with a product that can be designed this way, now let's beat it up, assuming it's done well. And maybe we can give disclaimers so that people don't take that out of context and pitch their crappy thing. But I think that would be something that I would like to do because it seems like every freaking conversation that we have goes back to, the same commercial kind of deal. And it's like, okay, we got to be better. But I also understand where people are coming from because the last thing you want to do is endorse something that's 1% and then 99% is not done well. And so I get the risk of something like that.
Yeah, and I think going back to just some of our missions and values of what we're trying to do is we're trying to just make the industry better, make the product better, make the circumstances better, just be better across the board. Which is why I love the name Better Wealth, just because there is a stigma and there is a name, but if you do work with somebody that does help you and be better to your situation, which is the most efficient path, there's a lot of really good value that can come from it. And if we can change the industry one policy at a time, one content at a time, we can do anything.
Hey, I knew I
God for president.
I told you early on we weren't going to read any of the comments. I do want to read one comment. It's from Fly by LLC.
Nice.
And he said, the dude making commissions of selling whole life is a whole life shill. He sells whole life because he makes 2 to 3 times commission, not because it's better. Okay, buy term, invest the difference into an IRA or 401k. That goes to show that those are the type of comments we get on a daily basis. That's why we appreciate all the encouraging comments and the actual like tell us how we can improve, ask questions. Like we read everything and it's helpful to hear this. And my point here would be, let's just break this down. Am I a shill for selling whole life. Okay, I can see where he says that because I've written a book. I'm definitely in the 1%, Dom, of people that make content around insurance. So I'll own that. I don't know the definition of a shill. Can we define? Can you look up on ChatGPT what the definition of a shill is? And then the
A,
next point is
a
what did he say?
shiller is like somebody who's scammy, but shilling pushing their product.
Okay, I would push back on that. I think if you actually looked at our content, you could call me a lot of different things. I don't know if shill would be that, but obviously there's going to be some people that agree with him. He sells whole life because he can make 2 to 3 times the commission, not because it's better. I straight up disagree with that, and I would be willing to die on this mountain. Is like if there's a better way, let's do it. I really do believe serve people better. Reason I believe in permanent life insurance is I believe it's an amazing tool when integrated with other assets, makes everything better. If that's not the case, you should not do it. It doesn't matter if I'm getting paid 0 commission or 10 times the commission. The commission does not matter. It's is this the better thing for you? Period. So that's what I would say there. And then the buy term invest difference into an IRA or 401k. Buy term and invest difference can be a strategy that works really well for a lot of people. And that's a statement that is like, okay, yeah, buy term invested difference, not a bad strategy. And there may be a world where permanent insurance can enhance that, but do whatever is better for you. It sounds like this person, it's working out really, really well for him or her. I'm assuming it's a guy. And so wish this person the absolute best. And I hope the buy term and invest the strategy difference is working out great, and appreciate, like always, encouraging comments to and uplift our day and make us better. And I'll make sure to wear my shill hat the next time I come on.
With that being said, thank you again for watching the fastest growing life insurance podcast in the entire universe with Dom and Caleb. And until next time.
We've helped people unlock millions of dollars in hidden value just by reviewing their old life insurance policies. Unfortunately, thousands of people do not have life insurance policies set up properly, which could be costing them a lot of money. If you have a policy, the few minutes it takes to fill out our form could be the difference between continuing to waste money or unlocking serious value. If you qualify, we'll review your policy 100% for free and give you the honest breakdown you deserve. Click the link in the description or take comment below to apply.